Welcome to Kings and Queens Accounts class. At this time, we're going to be looking for this lesson on managing inventory. Managing inventory. All organizations and institutions have inventory to manage. All right, and so we want to see how in accounting these inventories are managed. And to do that, we are going to be looking at three objectives today. Identify the accounts used to manage inventory, interpret inventory transactions, and three, we're going to record inventory transactions. So these are the tasks that we're going to accomplish in this lesson. Let's get it on. So, the first thing that we'd like to look at this time would to identify the accounts used in managing inventory. One, the purchases account. Two, the sales account. Three, the return inward, and four, the return outward. Now, the return inward is also called sales return, and the return inward is also called sales return, and the return outward is also called purchases return. Now, in organizations, goods and services move inward to the business and from the business. So goods move into the business and it also move out of the business. Now, when goods are stock, and when we speak about inventory, we're really referring to the stocks that are traded. All right? What is it that they are buying and selling? What is it that they are producing and selling? And that is referred to as inventory, or it is referred to as stock, or stock of goods. Now, the inventory or the stock of goods, the organization have stock moving in and they have stock moving out. When stocks are moving in, then we are going to be opening the purchases account. So when stock move in, yes, when stock moves in, yes, it is the purchases account. The other account that also account for stock coming in would be our return inward when stock comes in. When stock goes out, then it is sales. So this is going out. And return outward, stock is going out. So that is what what organization does when they are managing the stock or the inventory. You have stock going out and stock coming in. So when goods are inventory coming in, it is the purchases account or the return inward. And we say that another name for return inwards is what now? Return, sales, return. And when stock is going out, we are dealing with our sales account or our return outwards. Let's talk a little bit, let's go a little bit deeper. So whenever we are buying goods, so like bought goods or inventory, it is going to be the purchases account that will be open. When we are selling goods, so sold goods, it is the sales account that is going to be affected. When customers return goods to us, so customers return goods, then it is the return inward. When we return goods now to our suppliers, it is return outward. When business return goods to suppliers. All right, so are we there? So we would have accomplished objective 1 by establishing the accounts that are used when goods or inventory is moving either inwards or they're moving outwards. So let's go again. Purchases, when inventory is coming in, when we are buying it, yes, it is the purchases account. When goods are going out, when we are selling it, it is the sales account. When the goods is being returned by the customer to us, it is the return inwards account. And when the goods, when we, the business, are returning goods to the suppliers, it is the return outward account. All right, let's now look at some transactions and see if we can interpret what are the accounts affected in these transactions. So, sold goods for cash. Sold goods for check. Sold goods on credit to R. Jones. Now, these are 3 sales transactions. 3 sales transactions. Now, the transaction says sold goods for cash. Remember in our last lesson we indicated that when we're going to interpret any transaction, we're going to ask ourselves at least 2 questions. All right? So what are we selling? We are selling goods. And because we're selling goods, we open what now? The sales account. What are we receiving when we sell the goods? Cash. So the next account is cash. Next transaction. Sold goods for check. Right away, we would know this one is going to still be sales account affected. And it says for check. What are we receiving? We're receiving a check. But what did we say in our last lesson? That whenever we see the word check in the transaction, we know it represents bank. Okay? So once the transaction says check, we know it is bank. Why? Because checks are drawn on accounts at the bank. The third transaction says sold goods on credit to R. Jones. Sold goods on credit to R. Jones. We know right away this is what? Sales. Once it says sold goods and it's been sold on credit. Who are we selling the goods to? We're selling the goods to R. Jones. Remember, we always ask 2 questions. Yes? When we're going to try to determine the accounts. All right, let's look at another set of transactions. Bought goods for, paying by cash. Next, bought goods paying by check. And the next is bought goods on credit from a lead. 3 sets of purchasing transactions here. So, what are we seeing? We bought goods paying by cash. Now, 2 questions. 1, what are we buying? We are buying what? We're buying goods. And once we're buying goods, it is our purchases account. So we know that that is the account that is affected, purchases account. What are we using to buy the goods? Cash. So cash is the next account affected. Let's go to the next one. So this one would be as well, purchases account. And we have check, and we know once it's check, it is bank. Bought goods on credit from A. Again, this is going to be our purchases account, and we're buying it from who now? A. So it's going to be A. So it's between purchases and A. Very good. So we have sought to interpret some transactions, trying to determine the accounts affected in the transactions. All right, so let's move on now to the third objective. And that is now we are going to seek to record the transactions, okay, using the double entry system, the T accounts, right, from the transactions. So let's get on with that now. So let us say it is October 1st, right, 2020. We bought goods on credit from our black, and it is $2,000. That's the first. On October 2, we sold goods for cash, $5,000. Our next transaction is October 3. Yes. Return goods to our block, $100 worth of goods. And our next is October 5. We sold goods on credit to M. All right, let's say it is M. Brown. Okay, and this amount of money is 400. All right, so we have 4 transactions that are on the board, and we are going to be recording these transactions using the double entry system. So let's begin. I'm going to be taking out these objectives here. All right, so let's go. So we're going to open our accounts. One. Okay, there's another one here. Okay, so the first transaction says we bought goods on credit from R Black. Now, two questions we'll ask ourselves would be what? Now, what are we buying? Goods. If we're buying goods, then it's going to be the purchases account. From whom are we buying it? It says we're buying it from R Black. So, our two accounts affected would be purchases account, and we're going to have next account is R Black account. Remember, this side is called what now? Our debit side, and this side is our credit side. Debit side and credit side. So let's record the transaction. Now that we have identified both accounts affected in the transaction, purchases and Black, the next accounting rule is that we're now to determine which account will be debited and which will be credited. So, what are we going to do? What are the two questions we're going to ask now? One is in relation to which account is giving and which is what now? Is receiving. And if it is giving, we credit, and if it is receiving, we debit. So, we are buying goods. Are we receiving goods? Yes. So if we're buying the goods, we are receiving it. So if we are receiving the goods, then the purchases account will be debited. Accounts that receives, we debit. So we go in the purchases account and we're going to record October 1. And we have, what now? The name of the other account is R Black. And the amount of money is $2,000. So we debit purchases account. The next trick to it, remember we said, was what now? Once we have identified where we're recording the first account, in the first account, the second one is always automatic because they operate opposite with each other. That means if we're debiting in one account, we are certainly going to have to what? Crediting the other. So once we have identified that this is to be debited, then automatically this account is going to be credited. So it is October 1st, and the name of the account is purchases and $2,000. Okay, so we debit purchases and credit Black. All right, our next transaction says we sold goods for cash. If we're selling goods for cash, then we are going to sold goods will mean our sales account. So what we're going to ask ourselves is, what is it that we're selling? We're selling goods. And once we're selling goods, we are going to open our sales account. And what are we receiving when we sell the goods? We're receiving what? Cash. So the sales account and cash. So we'll open the sales account. We open the sales account, and the second one we open is the cash account. So, next thing now we're going to interpret which account are we going to be debiting and which account we are going to be crediting. So let's go. So we are selling goods. Remember, accounts that is giving, that means it is whatever is leaving the business, it is giving, so we credit. If the item is coming into the business, we are receiving it, then it is debited. So let's go. Sold goods, when we sell the goods, is it coming to us or it is leaving us? Certainly, brilliant. It is leaving us. Once we're selling the goods is leaving us. So we're giving it. And if we're giving it, then it is going to be credited. So if we're going to be credited, we come on the credit side. Remember, this side is referred to as the credit side. This is the debit. So October 1st, the name of the other account is cash, and we write it here. And the amount of money in that transaction is $5,000. So we record the $5,000. What's the next trick now? Is once we've identified correctly the first entry, we can determine what? The second entry, because they always operate opposite. So since we credit in this account, then automatically we will what now? Debit in the cash account. So October 1st. Name of the other account is written in the middle, sales. And the amount of money is $5,000. So we have made the entry by crediting the sales account and debiting the cash account. All right, we have 2 more to do. So we're going to have to erase this to get it done. All right, so return goods to R block. Let me put back R block's account. Let me put it back. R block. And in the transaction earlier, we had credited R block October 1st. Yes, October 1st, and it was purchases. And the amount of money was what now? Was $2,000. In this transaction, we are going to need to go back to our blocks account. All right. Let me put back the purchases just that you can follow. Purchases account, and we have debited the purchases account by saying October 1st, our block, and we have put in what now? The $2,000. All right, that was what was there. Let me allow it to stay there, and then I'm going to attempt to draw an account down here. And this account I'm going to draw down here now would be the return in what? Let's interpret. It says return goods to our block. Not inward at all, it is return outward. So goods, what are we returning? Goods. Is the goods coming to us or going out? The goods is going out. So if it's going out, it is return outwards. So we're going to have return outwards here. All right. So it is return outwards. Okay. And the next account would have been what? Our block. We're returning goods to our block. Our block is receiving it because we're returning it to him. So it is going to him. Because the goods is going to our block is receiving it. So in our block's account, we're going to record it on what? The debit side. Because accounts that receive, we debit. So we put it here. October. The date here is October 3rd. And the name of the other account in the transaction would have been returns outward, and the amount is, how much is it returned? 100. All right. Now that we have debited in this account, what is going to happen to this one? Automatically, it must be what? Credited. So we're going to have October 3rd. Name of the other account is R Black. And the amount is $100. Great. Now, we're going to go to the last one. October 5, we sold goods on credit to M. Brown. All right. So we already have a sales account, and we need one other account, and we're going to try to let it fit right here. So it's going to be M. Brown. M. Brown account. So the transaction said we sold goods on credit to M. Brown. So M. Brown is one account and the other account would have been sales. Right? So now, we are selling. The goods is moving from us. So if it's moving, we're giving. Accounts that gives we credit. So we go to the sales account and we're going to write October 5. The name of the person to whom the transaction is related is M. Brown. So we write M. Brown. And the amount of money is $400. Now if we credit in this account, then automatically in this one we are going to debit because it operates opposite. So it's up October 5 and it's going to be sales and it is $400. Ladies and gentlemen, this is it. We have tried to explain the movement of accounts inventory in an organization. When goods are moved into the organization, we are opening the sales account and the return when moving inwards, it's goods move inwards, you're going to open the purchases account and the sales return. When the goods going out of the organization, it is the sales account and the return outward account. And we have showed you how to record the transactions using the double entry system. Thank you very much for your participation and for sharing with us. We will be moving on in the course and we hope that you have understood this lesson. See you on the other side when we go to the next lesson. This is Kings and Queens Accounts class. Have yourself a good day.